What's up, you guys? I'm going to go over GE Aerospace. This is a request from a member, and instead of typing up an analysis, I thought because it's after hours, maybe we should do a video. GE Aerospace is a spin-off of what used to be GE. GE split up into multiple companies. It became GEV, GEHC. So this was the healthcare, and then GE became the aerospace. GEV became I believe, power company. So you can see that's been doing well. And then there's more, but the GE is the one we're focused on today. And this one is an American aircraft company, and it pretty much produces jet and turboprop engines. So it makes engines for planes, whether that's commercial or military, anything aviation. And what's great about this stock is that it is one of the most it's the most prominent producer for Boeing on the majority of their planes, which is exactly why it's been going up so much. When we look at GE recently, we could see that the company's revenue has been ramping up over the last 12 months. 14% growth in Q4 of 2024. That moved to 11%, more impressively 21 and even 24% in Q3 2025. Now, the company has not reported its fourth quarter earnings for 2025 yet, but it will report in 2 days, and we are expecting strong earnings. In fact, you could see right here, the latest update from tradingview.com is that the company is expected to see a 14% revenue growth, which would mark the year, because it's Q4, so it'll be all 4 quarters, which would put it at 18% year over year growth. That outdoes the previous year, and you can see it significantly does the years before, when GE was struggling for more than 5 years to get revenue going. Now, alongside revenue growth, we've been seeing its net income has also been growing at 28, 61, and 16%. That leaves it at a price to earnings ratio of about 43. Now, that is high because you typically want to buy a company closer to, the closer it is to 1 would be the best, because you're paying very little for the value. A price to earnings ratio of 43 is considered high. The S&P 500 right now is about 30, 29 or 30. So it's higher than the S&P 500, but nonetheless, it still seems to be a pretty good buy. And the reason being is because the company is ramping up net income, and that is expected to continue going in the years ahead, which justifies the higher price to earnings ratio investors are willing to pay. Remember, the market prices things for what's expected to happen, not what's already happened. And looking ahead, GE is expected to ramp up profits significantly. You can see that they nearly go up by about 50% in the next 3 years in terms of earnings per share, revenue, despite the fact that revenue goes up by a smaller amount. So the story for GE's going forward is going to be how well can they produce profits. Revenue has ramped up, which is fantastic, but for a high manufacturing company that has a lot of overhead, investors are curious to see how well is this company managing its money. In this case, we can see that GE has been managing money efficiently over the last 12 months. We want to see that trend continue for the stock's rally to continue. Now, investors entering the stock at this point need to recognize that it is trading at record highs, and it is pretty overextended. We can see that there's a little bit of weakness in buying at these highs, but that doesn't take it out of the race. You just have to realize that you're paying a higher premium, which means that the company has to deliver more significant earnings in order for investors to justify a higher price, which is exactly the test that's coming in 2 days. And so if you're an investor who's buying the stock or looking to buy the stock, you can either get into a small position before earnings, or wait for the earnings report to take place and see if it gets a good reaction from the company. Now, the stock is trading near those record highs as we head into those earnings, so it will be a big test. If we see a big gap up on strong data, and if they reaffirm their strong guidance going forward, this may remain a strong stock. Now, another company I'd like to just briefly mention is Boeing. And the reason why I want to mention it is because We're holding Boeing, and we've been holding it for quite some time because we believe that the aviation industry is starting to boom. Plane orders are at record highs, even higher than they were before the pandemic, and that's only benefiting manufacturers like Boeing. And luckily for GE, it is the primary producer for Boeing's engines on many of their new planes, including the 737 and the 787 Dreamliner, which is the newest plane that's getting a lot of orders. And so, as you're looking at GE and deciding whether or not you want to buy the stock, get out of the stock, hold the stock, look at Boeing's orders because it'll give you some good insight of how GE is going to, of GE's total backlog, rather. So I hope that was helpful in terms of fundamentals. Let's talk about the technicals real quick if you need some guidance there. In terms of the resistance, you can see that there's a resistance around 332 to 333. That's going to be its all-time highs, so we're going to place a resistance there. The stock has been hanging on around this levels for quite some time, so we're going to put a support right around 300 in this right here, and then if it breaks below 300, the next available support is going to be right around 280. Just because the stock breaks 300 or falls to 280, it doesn't mean it's a bad buy. In fact, if they post super strong earnings and they gap down to 280, I would watch for a reversal. This could be a potential buying opportunity on a stock that hasn't given a big pullback in quite some time. So I think the best thing to do here is just wait and judge to see earnings, keep a position very small ahead of those earnings, and then increase if earnings meet expectations and exceed expectations outlook.